Good morning and welcome to today's board meeting. We have two items on our agenda for today. The first, an agenda decision related to debt modifications and extinguishments. And then we'll wrap up the meeting with an update related to our codification improvements project. So with that, let me turn it over to our debt modification and extinguishment team and Chris to tee us up this morning. Good morning, Chris.
Good morning, Rich. The purpose of today's session is to summarize recent stakeholder feedback, including feedback that was received as part of the 2025 invitation to comment on agenda consultation on debt restructurings. So that includes feedback on debt modifications, extinguishments, and troubled debt restructurings, or TDRs. On the basis of that feedback, the board will consider how it would like to proceed in this area. As background, topic 470 in the codification, debt, provides accounting and reporting guidance for borrowers, including guidance on a borrower's accounting for changes to its outstanding debt arrangements. In applying that guidance, a borrower that modifies or exchanges non-convertible term debt often has to consider both the guidance on TDRs in subtopic 470-60 and the guidance on modifications and extinguishments in subtopic 470-50. Over the past few years, stakeholders have raised concerns with both of these models. In response to the 2021 agenda consultation, some comment letter respondents questioned whether the economics of TDRs are faithfully represented by current accounting outcomes. Some also identified application challenges with the debt modifications and extinguishments guidance in subtopic 470-50. In 2024, the Private Company Council, PCC, identified debt modifications and extinguishments as an agenda priority and supported research in that area. As part of that research, PCC members and the staff conducted outreach with private company users, preparers, and practitioners to better understand what improvements could be made to the guidance. Some PCC members also highlighted challenges applying the TDR guidance. In October of last year, the PCC established a working group to consider ways to address issues in these areas for private companies. However, the working group paused further work earlier this year pending the board's consideration of the 2025 agenda consultation feedback. Separately, in November of 2024, the board added a project on accounting for debt exchanges to its technical agenda on the basis of an EITF recommendation. The project was intended to address concerns that applying the 10% cash flow test on a creditor-by-creditor basis to certain multi-lender debt exchanges is both challenging and results in outcomes that do not reflect the economics of the transaction. The board issued a proposed ASU in April 2025, but paused further redeliberations in March of this year, also pending consideration of the agenda consultation feedback. With that as background, I'll now turn it over to Grace and then Gus to give a short overview of subtopic 470-60 and subtopic 470-50, as well as the agenda consultation feedback we've received more recently on those areas of guidance.
Thank you, Chris. I will now summarize the feedback received on subtopic 470-60, troubled debt restructurings by debtors through the 2025 Agenda Consultation ITC. As background, a restructuring is accounted for as a TDR if both 1, the debtor is experiencing financial difficulty, and 2, the creditor has granted a concession that it would not otherwise consider. If a restructuring is not a TDR, a borrower generally applies the guidance in subtopic 470-50. Therefore, borrowers typically first assess whether a restructuring qualifies as a TDR, and if not, then apply the guidance in subtopic 470-50, even though TDRs are significantly less common than non-troubled modifications and exchanges. Overall, stakeholders expressed mixed views on whether the board should prioritize changes to the TDR guidance. However, stakeholders that supported standard setting generally raised two concerns. First, whether the current TDR accounting model provides decision-useful information, and second, whether the guidance creates unnecessary complexity. On decision usefulness, stakeholders most often focused on the accounting that applies when the undiscounted future cash payments are less than the debt's carrying amount after a restructuring. In those situations, the borrower recognizes a restructuring gain, applies all subsequent payments to reduce the debt's carrying amount, and recognizes no interest expense after the restructuring, even if the restructured debt is interest-bearing. Some stakeholders said that outcome is difficult to explain and may not reflect the economics of the ongoing borrowing arrangement. One stakeholder also observed that investors often ask follow-up questions about results that appear inconsistent with the purpose and economics of the transaction. On complexity, stakeholders noted that borrowers may need to evaluate both the TDR guidance in subtopic 470-60 and the modification and extinguishments guidance in subtopic 470-50. Some stakeholders said that sequencing creates cost and complexity, particularly because determining whether a borrower is experiencing financial difficulty can be subjective, and determining whether a creditor has granted a concession can be challenging. Many stakeholders that supported eliminating the TDR guidance recommended requiring the application of the debt modifications and extinguishments guidance in subtopic 470-50 to those restructurings. Those stakeholders generally said that subtopic 470-50 model should be sufficient for debt modifications and exchanges. Some also noted that they did not anticipate significant challenges in determining the fair value of restructured debt instruments if extinguishment accounting were applied. Other stakeholders did not support eliminating the TDR guidance or did not view the issue as a high priority. Those stakeholders generally said that TDRs are not commonly encountered outside periods of economic stress, the guidance is relatively well understood, and they do not commonly observe significant application challenges. Some stakeholders suggested alternatives short of eliminating the TDR guidance. For example, some suggested measuring restructured debt at its principal amount so that the balance sheet reflects the contractual obligation and interest expense reflects the stated contractual rate. Others suggested more targeted improvements to the existing guidance. With that background on the TDR specific feedback, I will turn it over to Gus to summarize the agenda consultation feedback related to subtopic 470-50.
Thank you, Grace. The staff also received feedback in the 2025 Agenda Consultation ITC on subtopic 470-50, modifications and extinguishments. As background, subtopic 470-50 requires borrowers to determine whether a debt, modification, or exchange should be accounted for as a modification or extinguishment. Under the current guidance, extinguishment accounting is required when the present value of the cash flows under the new agreement differs by at least 10% from the present value of the remaining cash flows of the existing debt. This is referred to as the 10% cash flow test. If extinguishment accounting applies, the borrower derecognizes the existing debt and recognizes a gain or loss based on the difference between the carrying amount of the existing debt and the fair value of the new debt. If modification accounting applies, no gain or loss is recognized, and the borrower instead recalculates the effective interest rate prospectively based on the revised terms. Although the 2025 ITC did not include a question specifically about debt modifications and extinguishments, several stakeholders nonetheless identified the guidance as an area of priority for standard setting. Those stakeholders generally indicated that the current guidance is complex, costly to apply, and can produce outcomes that are difficult to explain. Stakeholders identified several specific areas of complexity. First, they highlighted the requirement to apply the guidance on a lender-by-lender basis, which can be challenging in syndicated lending agreements and on other transactions involving multiple creditors. Second, stakeholders noted that the 10% cash flow test can be difficult to apply and may not always distinguish transactions in a way that reflects their economics. Third, stakeholders raised concerns about how prepayment features affect the analysis. Because the borrower must perform the test, both assuming exercise and non-exercise of the prepayment option, and then use the scenario that produces the smaller change in cash flows, prepayable debt may qualify for modification accounting even when the economics of the arrangements have changed significantly. Stakeholders suggested several possible improvements. Some suggested reconsidering the unit of analysis for the borrower's assessment. Others suggesting replacing the 10% cash flow test with a more principles-based framework, or providing additional implementation guidance and examples to address common application issues. Overall, the feedback suggests that stakeholders continue to experience operational challenges applying subtopic 470-50 and would support the board exploring ways to simplify the guidance while maintaining decision-useful information for investors. With that background, I'll turn it back to Chris to discuss the board's agenda decision criteria for this topic.
Thanks, Gus. Now that Grace and Gus have walked through the feedback we received on subtopics 470-60 and 470-50, I'll turn to the staff's analysis of the board's agenda decision criteria and question 1 in the board meeting handout. That question asks whether the board wants to add a project to its technical agenda on debt modifications and exchanges. As a reminder, there are 3 agenda decision criteria. First, we analyze whether there is an identifiable and sufficiently pervasive need to improve GAAP. Second, we analyze whether there are technically feasible solutions for which the perceived benefits are likely to justify the expected cost of change. And third, we analyze whether the issue has an identifiable scope. On pervasiveness, the staff thinks the 2025 Agenda Consultation ITC feedback, in addition to the feedback received from the PCC, private company stakeholders, and through our outreach, collectively indicate that there is an identifiable and sufficiently pervasive need to improve GAP in several areas. Stakeholders identified challenges with both the TDR guidance in subtopic 47060 and the modification and extinguishments guidance in 47050. For TDRs, stakeholders raised concerns, as Grace mentioned, about both operability and decision usefulness. And just to reiterate, those concerns both related to the fact that it can be difficult to determine whether a borrower is experiencing financial difficulty and has been granted a concession, and others have questioned whether the current TDR accounting model faithfully represents the economics of a restructuring, particularly in those no interest expense scenarios. But I just wanted to highlight too, some have also expressed a similar concern when the effective interest rate is not reduced all the way to 0%, but is just merely reduced compared to what the terms of the debt or the fair value of the debt would indicate. For subtopic 47050, Gus highlighted feedback from stakeholders that the guidance is complex and costly to apply. And again, that was related to challenges applying the 10% cash flow test on a lender by lender basis and some of the outcomes related to prepayment features. We also heard from investors in more recent outreach that the distinction between modification and extinguishment accounting is not particularly meaningful to their analysis, and that the identity of the lender should not drive significant differences in accounting outcomes in the way they do today. In addition, we've also identified disclosure gaps. Because detailed debt disclosures are required only for SEC registrants, users of private company financial statements may not consistently receive information about debt arrangements that is decision useful. On whether there are technically feasible solutions for which the benefits are expected to justify the costs, the staff thinks that there are feasible alternatives that the board could pursue. The alternatives in the handout were developed on the basis of stakeholder feedback and are intended to reduce cost and complexity, improve comparability, and better align the accounting with the economics of the restructured debt. Those alternatives include changes to the recognition and measurement guidance in subtopics 47050 and 47060, as well as potential disclosure improvements. Finally, the staff thinks a project would have an identifiable scope. The project could address the borrower's accounting for debt modifications and exchanges, the TDR guidance, or both. And then the project could also address debt disclosures for entities that are not public business entities. For those reasons, the staff recommends that the board add a project on debt modifications and exchanges to its technical agenda. I'll pause there and ask the board to discuss question 1 in the board meeting handout.
Okay, any questions for the staff on the background information? All right, not seeing any. So would you like to add a project on debt modification and exchanges to the technical agenda? Sue?
Thanks, Rich. And wow, that was a great tee up. And I appreciate all of the highlights of all of the outreach and activities that you did along the way with the Private Company Council and their working group, as well as other stakeholders in the ITC and the incremental outreach that you did following some of that feedback. So I think that was a great summary. And I think you did a nice job of highlighting our agenda criteria and whether it has been met or not. I do think it has been met. I would add a project. I think that we've heard consistently through these multiple touch points with stakeholders about that the existing guidance is overly complicated, particularly the 10% test. Sometimes it results in unintuitive outcomes. And so I think that some of the feedback that we've got has been really helpful in identifying for me whether there's operable solutions. And I think that's been the challenge. I think that we've heard pretty clearly what the problems are, but the solutions are what's really hard. I think we learned a lot on debt exchanges. And with that, I would add a project.
Thanks, Sue. Joyce?
Thanks, Rich. And good morning, everyone. First, I'd like to thank all of the stakeholders who provided feedback to us, which has enabled the staff to do such a comprehensive job of research and now providing what I agree with Sue is an excellent tee up on this topic. I support the staff recommendation. I agree that the agenda criteria have been met. We've heard from preparers, both public entities and private entities, as well as from investors, that there are opportunities to improve the accounting and reporting in this space. For preparers, certainly a key focus is operability and simplification. The challenges, as you've mentioned, in preparing the analysis for the 10% cash flow test, and certainly on a lender by lender basis. And from an investor perspective, the focus is on improving the usefulness of the accounting and the disclosures, so that they can better assess a borrower's ability to service its debt. And I think in particular, as you've mentioned, the accounting outcomes that investors are concerned about, such as the distortion of the interest rate coverage, and other key credit metrics that they rely on, could be addressed in this project. Ultimately, investors just want to know what has economically occurred as a result of the transaction and why, regardless of whether or not the transaction involves an existing creditor or a new creditor. So a project focused on improving operability and simplification of the guidance and the relevance of the disclosures, I think could address these concerns, as well as other issues that you've identified by stakeholders.
Okay, thanks, Joyce. Marcia.
Thank you for the analysis. I also agree that this meets the criteria to add a project. I support adding a project. We often are faced with a situation where you have one particular group of stakeholders that may say this is a priority, but you haven't heard anything from another group of stakeholders. In this case, I think we've heard from preparers, practitioners, and investors that there's opportunity for improvement, and I think it's appropriate that we spend time looking into it.
Great. Thanks, Marcia. Fred?
Thanks, and thanks to the team, and also I think that as the other board members before me have talked about, I think this certainly meets the agenda criteria. I would say, just from an investor standpoint, I think what we've heard from investors primarily is what they really want to know is they want to know the amount owed and the ongoing interest expense that companies have. And I think the challenge that we have is applying fair value to own debt creates some distortions. And in modification accounting, the changes, the move away from the actual interest expense owed to the interest expense accrued through modification accounting is also problematic. So I think we clearly have problematic accounting that creates issues for investors. And I think that means, in my view, that we have a problem that we need to fix.
Thanks, Fred. Kathy?
Thanks to the team and thanks to all the stakeholders. I agree with my fellow board members, and I won't repeat too much. I mean, I think when you get stakeholders from a broad range of backgrounds saying the guidance is overly complex and the information produced is not decision useful, I think we have something we should look at. And to Sue's point, finding the solution is key. And I think, you've identified some feasible solutions, and I think you've scoped it correctly. So appreciate the work.
Thanks. Hillary?
Appreciate all the work done by the team, as well as for all of our stakeholders who provided their feedback. Certainly agree with all of my fellow board members that I think the current model presents challenges, not just in its application, but in the information that it produces, right? So for me, that's a clear win of we obviously have a sufficiently pervasive need and an identifiable need to improve GAAP. And I think we're going to talk about the feasible solutions, which I think there are, and I think we have appropriate scope here. So certainly support adding this to the agenda.
So I'll make it unanimous on adding a project to the agenda. I think the unique challenge we have here, which is really not unique, is anytime you're accounting for a contract, you have to make a decision on what changes can you make, which continues your accounting versus it's a new arrangement. And when you go through the debt modification guidance and add in TDRs, I I think today the answer is not only not intuitive always, but it doesn't best reflect the economics of the underlying arrangements. Now, I'm sure we will all have our own views on exactly how to best reflect the economics, but that'll go into the next question. So with that, maybe we can start with Grace.
Thank you, Rich. Question 2 in the board meeting handout asks whether the board wants to require extinguishment accounting for all modifications and exchanges within the scope of subtopic 470-50 that affect the timing or amount of cash flows or the fair value of an embedded conversion option. That approach would eliminate the 10% cash flow test. We think it would directly respond to investor feedback about decision usefulness and significantly simplify the guidance. On decision usefulness, investors have indicated that the distinction between modification accounting and extinguishment accounting is not particularly meaningful to their analysis. They also indicated that extinguishment accounting may better convey the economic substance of transactions that defer principal, change interest rates, or otherwise significantly revise the borrower's obligation. This approach would also reduce the emphasis current guidance places on the identity of the lender. Under current guidance, modification accounting is available only when a modification or exchange occurs with the same lender. As a result, economically similar transactions may be accounted for differently depending on whether the lender changes. The staff thinks that distinction does not always align with how investors analyze the borrower's obligation. In addition, eliminating the 10% cash flow test would address some unintuitive outcomes under current guidance. For example, prepayable debt may qualify for modification accounting even when the economics of the arrangement have changed significantly. The staff also thinks requiring extinguishment accounting for changes that affect contractual cash flows would provide for guidance that is more operable. Stakeholders identified several areas of complexity in subtopic 470-50, including applying the guidance on a creditor-by-creditor basis in syndicated lending arrangements and applying the 10% cash flow test. Eliminating that test should reduce the need for detailed quantitative analyses and reduce interpretive questions about whether a modification or exchange is substantially different. The staff also considered potential disadvantages of this approach. First, the approach would represent a broader change than some stakeholders have said is necessary. Some stakeholders have said the existing framework is generally well understood and does not create significant challenges in practice. Others opposed expanding extinguishment accounting, including in response to the debt exchanges project, because they view some cashless exchanges with existing creditors as better reflected by modification accounting. Second, expanding extinguishment accounting could affect debt ratios and increase earnings volatility because borrowers would recognize gains or losses at the modification or exchange date. Some stakeholders also raised concerns that applying extinguishment accounting to relatively minor changes could create opportunities for structuring or opportunistic gain recognition. Third, fair value measurement could impose incremental cost, particularly for non-public business entities. Non-PBEs specifically are not required to disclose the fair value of their debt instruments each period. However, the staff thinks that concern could be addressed through the principal amount measurement election discussed by later questions. By contrast, public business entities already are required to disclose the fair value of issued debt instruments, which should mitigate the incremental cost for those entities. The staff also explored other approaches, including a rebuttable presumption that the stated interest rate reflects a current market rate and narrower changes focus on multi-lender arrangements. Outreach participants expressed mixed views on those approaches, and some questioned whether they would meaningfully reduce complexity or go far enough to address the concerns with current guidance. On the basis of this analysis, the staff recommends eliminating the 10% cash flow test and requiring extinguishment accounting for modifications and exchanges that affect contractual cash flows or the fair value of an embedded conversion option. Although this would be a significant change to subtopic 470-50, the staff thinks the expected improvements in decision usefulness, comparability, and operability justify the change. With that, I'll pass it back to the board to discuss question 2 in the handout.
Okay. Any questions for the staff on question 2? We have question 3 where we get into the meat of what are the cash flows, but Sue, can I start with you again?
Sure. So I would agree with the staff recommendation here. I would require extinguishment accounting for all modifications and exchanges within 470-50. I think the significant basis for my view is really the feedback that we got from IAT, from the Investor Advisory Committee. And, in that, as you pointed out, they prefer a single model. and that there be transparency around gains and losses, and that they didn't really find the distinction between modification and extinguishment accounting meaningful. So that was a significant basis for my view, but complementary to that feedback from preparers and practitioners, the complexity piece. And so I think it solves that too. So I think it's also directionally consistent with the debt exchanges project, notwithstanding. Now, we haven't gotten to the other issues, but the one on whether we need an election for other than public business entities is going to be important. And I also think that the decisions we make around disclosures in this regard is going to be very important.
Okay, thanks, Sue. Joyce?
I also support the staff recommendation. I agree that requiring extinguishment accounting could provide a more simpler and consistent model, particularly when preparers are dealing with complex contractual terms. I also see that there is merit in establishing a new accounting basis for the new financing, because recognizing the effects of replacing the old debt at the transaction date could give investors greater transparency into the economic consequences of the transaction. And that is what we've heard in our discussions with IAC. From an investor perspective, the changes in the timing or amount of contractual flows can be an important signal that the financing arrangement has different risks that are embedded, and extinguishment accounting coupled with relevant disclosures would make those effects visible in the current period, including any resulting gains or losses. That being said, under an all extinguishment accounting model, there may be circumstances where the resulting accounting gain or loss is driven primarily by changes in valuation inputs, rather than a substantive change in the underlying economics of the financing. So I think it's a challenge that I guess we have to weigh against all of the potential benefits of moving in this direction. I think it's one that we should maintain consideration as we continue this project, because there could be concerns about viewing the original instrument as having been in substance replaced in those circumstances, when in fact perhaps it's really a fair value input market driven extinguishment gain or loss versus one that's really from the substance of the transaction.
Okay, thanks, Joyce. Marcia?
I like your suggestion. Like Sue, I think it is responsive to many of the comments that we've received and many of the criticisms about the current model. I also agree that it results in a meaningful balance sheet after it's applied. So I think it helps give a proper indication of what's going to happen in the future. And I think that's responsive to what Fred indicated, that is meaningful to investors as well. So while I understand that this is a change, I think it's going to be one that is responsive, and I support it.
Okay, Fred?
Thanks. I also support this. I heard a little bit something different at the IAC meeting, and that is that extinguishment accounting makes sense to investors because of the ongoing interest expenses more closely related to the cash interest expense that they experience. And that's what they really are driving for. And modification accounting distorts that and creates issues. So I think that's driving it. And I think we heard from IAC that in general, the extinguishment gains and losses are kind of excluded from analysis. So I think that's supportive of this direction, getting rid of the 10% cash flow test. I do believe that in certain situations, especially with troubled borrowers, that issue on the balance sheet issue and the extinguishment creates problems for analysis and borrowing. But I'm going to save those comments until we get to the TDR discussion, because really I think this is going in the right direction. I think outside of troubled problem borrowers where you have a real concession, I think it does provide better decision useful information. And I think in most cases, in a normal transaction, that extinguishment gain or loss is relatively modest. Thanks.
Great. Kathy?
Thank you. I agree with my fellow board members. Clearly, I understood why perhaps when FAS 15 was first introduced, it was this concept of a substantial change to the cash flows, but it's clearly not worked. It's created confusion and operability, and investors don't like the outcome. So I would get rid of the 10% test. I'm also drawn to people who say who the lender is on the other side doesn't really matter, right? If there's a change in the timing or amount of the cash flows, that's a change in the economics, and we should pay attention to that. I mean, I'm sensitive to the gains, and I think Sue is right. We should think very carefully about how we disclose those. But I want to actually reflect on what the research says in this. So when you look at the research in this area on credit risk and fair value changes in debt, and this research kind of examines about a 30-year period across the market, the answers are fairly consistent with what happens. So the market actually understands the gains to be real, but also understands that the gains should be understood within the context of the greater set of financial statements. So when we get on to, for example, talking about TDRs are not happening in isolation. There's something else going on. Then when you look at the reaction to the actual gain, if it is recognized in the financial statements across a broad amount of metrics, it is decision useful to investors. They respond appropriately in the conditioning on what's happening. And actually, there's even research that shows if it's a fair value change in a debt that would be measured at level 3, that actually tells you something about management's perception of their own credit risk and can predict credit default swaps. So while I think I've heard you hear a lot that the gains aren't real, I think we should be really careful and look at the full set of what you see when you look at how the market responds to all this. However, it is counterintuitive and people get confused, right? Because your credit risk is going up and you get a gain. It's not actually obvious. So I think we should be very careful in how we disclose it. But I think we should be equally careful in thinking that these are not economic gains. I mean, that's how the market has responded to them at least over the last 30 years.
Okay, great. Thanks, Kathy. Hillary?
Yeah, appreciate all of the hard work and appreciate all of our other board members' comments with regards to this. I absolutely would support a broader use of the extinguishment model. I think that gains or losses, when you have a change in the terms of your debt instrument and it results in a gain or a loss, I think that provides information to investors. I think investors have told us that what they're getting today through modification accounting, to Fred's point, is not decision useful. And I do think that applying the extinguishment model better aligns subsequent interest expense more closely with your restructured cash flows. And, I think those things are really important, right? I think the existing model that we have today, I think, is very difficult to apply on a lender by lender basis, results in different outcomes based on whether it's an existing lender or a new lender. That has never made sense to me from an economic perspective, that you're going to have a different result based on that. And I think we've heard that from investors, that that's not something that's decision useful from their standpoint. I certainly understand some of the feedback that we got. It wasn't unanimous with regards to whether folks were necessarily, I think probably more from a practitioner perspective, supportive of moving all the way to an extinguishment model. And I understand that. We've had 30 years of a model that has tried to get you to a modification answer, right? If you think about it, we kind of built a model to get to a modification answer. And now we're saying, well, we think that actually we should be going in the other direction. I think the important thing is we're doing that informed by information that we think is going to be more decision useful from an investor standpoint, right? I personally think we had a model that was too precise, too prescriptive, and putting us in a situation where we weren't providing information that investors were necessarily using or understanding. So certainly, I think a model that's going to allow that to be applied in a consistent manner and is going to provide more decision useful information at a lower cost, I think is a significant win. So certainly support this change and support removing the 10% test and moving towards extinguishment.
Okay. Couple things. So I must admit, the concept of not having immaterial items drive your accounting certainly resonates. And I think our attempt with this 10% test was for that. The problem I have is when I look at the 10% test, it excludes things, or it makes you consider prepayable debt, which I think ignores the economics of the restructured debt arrangements. So I did spend some time on, could we fix the 10% test? And we certainly could fix it in the sense of trying to get it closer to what I would view as the economics. The problem is you'd still have to do a 10% test, and you still have to do it lender by lender. And so we would still have all those practicality issues. And then the question was, is it really worth it? And wherever you draw the line, you're going to arbitrarily end up on, or you're going to end up on one end or the other with very different accounting. So that all drove me to, no, we should probably just move to the extinguishment model for changes in cash flows. One caution, though, is while PBEs may disclose the fair value of their debt, we have a long history. You can read our lease accounting PIR report. You go back to stock compensation, where when people have to incorporate a footnote disclosure into their accounting, there's usually a level of refinement and precision that comes with that. So while there is a fair value debt disclosure, do not assume that that will be the number that someone books if they have to reset their debt to fair value. The other thing that I would just kind of strikes me is, while some may think that this will create too many resets to fair value, I know we still have this fair value option out there for debt. If we really think that's the case, I think we should revisit whether or not we even permit a fair value option for debt. Because if we don't think that makes sense, then why would it make sense here? So that's where we are. But now we'll get into the meat of what are cash flows. Gus?
Thank you, Rich. Question 3 in the board meeting handout asks which approach the board prefers in determining whether a modification or exchange affects cash flows for purposes of applying extinguishment accounting. Under current guidance, the 10% cash flow test considers all cash flows associated with modification or exchange, including principal, interest, maturity date impacts, and fees exchanged between the debtor and creditor. Current guidance also treats the fair value of certain non-cash consideration, such as written call options, as cash flows for purposes of the analysis. Separately, a modification or exchange involving a change in an embedded conversion option is treated as an extinguishment if the difference in the conversion option's fair value, measured immediately before and after the change, is at least 10% of the debt's carrying amount before the modification. A modification or exchange is also treated as an extinguishment if it adds a substantive conversion option or removes one that was substantive at the time of the change. The staff identified 2 alternatives for the board to consider. Under Alternative A, extinguishment accounting would be triggered only by changes to what could be viewed as the core contractual cash flows. That would include changes to the amount, form, or timing of principal or interest. It would also be triggered by any changes in the fair value of written call options or conversion options, including the addition or elimination of a conversion feature. Under this approach, changes to other contractual provisions, such as collateral, covenant requirements, guarantees, or recourse provisions, generally would not by themselves trigger extinguishment accounting. Fees associated with any of those changes would not affect the determination of the accounting treatment under Alternative A. The main advantage of Alternative A is that it is a more targeted expansion of extinguishment accounting. Because it focuses on principal and interest, it may avoid outcomes in which a relatively minor fee related to a covenant or collateral change independently triggers extinguishment accounting. However, the staff observes potential disadvantages to Alternative A. In particular, excluding certain amounts exchanged between the debtor and creditor could create questions in practice about how to distinguish between principal, interest, a fee, or compensation for another change in terms. Economically similar consideration could be structured or labeled differently, which could lead to different accounting outcomes and diversity in practice. In contrast to Alternative A, under Alternative B, cash flows would be defined in the same manner as under current guidance under subtopic 470.50. That means the analysis would include principal, interest, changes in maturity, and amounts exchanged between the debtor and creditor in connection with the modification and exchange, including fees paid to effect changes in other loan terms. As a result, Alternative B would lead to a broader application of extinguishment accounting than Alternative A. Alternative B would treat all amounts exchanged between the debtor and creditor consistently. From an economic perspective, Cash flows labeled as principal, interest, or fees may serve similar purposes. Alternative B would therefore better avoid form over substance outcomes and reduce the need to distinguish between economically similar cash flows based only on their labels. Alternative B also is more closely aligned with the framework stakeholders already apply today under the existing 10% cash flow test, which may reduce operability concerns. For those reasons, the staff recommends that the board pursue Alternative B. Although Alternative B could result in extinguishment accounting for a larger population of modifications and exchanges, the staff thinks it better avoids structuring opportunities, form over substance outcomes, and diversity in practice. I'll pause there and ask the board to discuss question 3.
Okay. And just as a clarification, in 2, we said cash flows. We mean any means any, right? That's the accounting definition. So any change in cash flows.
Yes. And that would,
now it's simply the cash flows. Yeah, I just emphasize that any means any point, because once we don't have a threshold, any amount will trigger this. And now it's what's in the population of cash flows. Okay. Kathy.
Thank you, Rich. So when I entered this, I was kind of drawn to principal and interest because that's what you really think. But I think your arguments around form over substance are well taken. And I think the distinguishing what a fee is from what an interest expense is and what a principal amount is going to get, I worry, will add to lots of complexity. I hear what Rich is saying about any amount, but I think that comes, I mean, if you work through the accounting, it comes back in later years in different ways. So I would be Alternative B.
Okay. Fred?
Thanks. It was interesting listening to Kathy's talk about the academic research on extinguishments and how, it has provided decision useful information in the past. I do get concerned that if we apply it more broadly, that there'll be some noise in that amount of extinguishment accounting, and those might be less meaningful if we apply it broadly. Just an issue. So I'm actually think I'd rather go. I think this is a toss-up. I think we need to do some more outreach on this question, and luckily we're not moving right now. But I'm kind of an Alternative A. I think that I think we need to have some kind of constraints on it. There are times when it really is just a modification. So I would be in Alternative A. But again, I think I'm looking forward to the outreach that we do with our stakeholders on this question. Thanks.
Marcia.
So I appreciate this question. I also appreciate what we're trying to do and the decision that we made with question 2. For me, one of the reasons that I supported that is trying to remove the complexity of the 90% or the 10% test. And I appreciate the comments that Alternative B could wind up including as an extinguishment something that on the surface many people would say was really not an issue, or it was too minor to have been triggering an accounting consequence. However, I think that the staff made a good point. Kathy highlighted that by trying to segregate types of changes, cash flows, introducing structuring alternatives, introducing more judgment about a fee, et cetera, and recognizing what we're really trying to go after is really to get the material changes as extinguishment accounting with the lowest cost to implement and the consistency in the presentation. I'm going to support Alternative B because I like this. I like the comments that were made about how this prevents the structuring. I think it's a more simplified application, and I'd be interested in the outreach.
Thanks, Marcia. So
I would also be supportive of the staff recommendation, which is Alternative B. I think that I like the idea of making this simple, and I think that this allows us to support the objective, perhaps as we go forward on eliminating some complexity. My fear is if we sort of narrow the population of cash flows, we inherently cause greater complexity in the analysis and the operability of the solution. So I would, notwithstanding some of the comments that others have made, I would support alternative B.
Okay, thanks, Sue. Joyce?
I also support the staff recommendation, alternative B. I appreciate Fred's remarks regarding trying to sort of ensure that the scope is not too broad and that minor cash flows aren't triggering outcomes that may not necessarily be economic. However, I do appreciate the arguments around the simplification and the complexity that could be introduced in trying to determine, what are the core cash flows and what are not. So here we can reduce the extent of judgment that is placed in those decisions and perhaps have greater consistency and comparability if in fact it captures all of the respective cash flows, including the related fees.
Okay, thanks, Joyce. Hillary?
Appreciate the different perspectives. I do agree with alternative B. Certainly, I think when I looked at alternative A, I was very much interested in it, thinking of it more like critical terms, right? Have the critical terms of the debt instrument changed? And is that really what should be driving the analysis? And honestly, I still think that's what should be driving the analysis is the change in critical terms, which I think of as interest and principal and right timing of those payments. But I do think that the staff, and I kind of wrote it in my memo when I was reading through it of like, okay, but what if I now say I'm not changing the principal, but I'm going to call it a fee, and that fee is going to be paid over the term of the debt instrument, right? Feels like, looks like principal changes, but is being structured as a fee. So was sensitive to that from a structuring opportunity perspective. I do think we have to be careful though, because there are structuring opportunities on either side of this line, right? Because to Rich's point, right, any change in cash flows would be looked at as an extinguishment. That also in and of itself is a potential structuring opportunity. I personally would be interested in something to the effect of, if it's the change in the terms is clearly inconsequential, right? That's something that's a little bit more of a principle on top of that. I know that wasn't necessarily something that was part of the staff recommendation, but something to think about of whether the intent and the substance of the change is something that is really important and not being used as a structuring opportunity, but we have a line, one side or the other. So I certainly do think, though, that based on the concern of how people would potentially put changes in cash flows through fees rather than in principal interest to avoid or apply the guidance, I think is something that is important from my perspective, as well as I think folks have been looking at all cash flows today, right, when looking at the analysis. And I think that is people understand how to do that, right? And I think that's something that would continue to help from the operability standpoint of this model going forward. So appreciate the different perspectives there, but I'm alternative B.
So I'll vote first, then maybe explain, but I'm alternative B, largely for many of the reasons that my fellow board members mentioned on the challenge of distinguishing between the two. That being said, banks make an awful lot of money on fees, and there's a fee for everything. And I do think I would be wanting to understand, at least as part of an exposure draft process, whether there's some administrative fee or document fee that we would think could be excluded under the theory of any means any. And so, a couple scenarios that I walked through in trying to understand this was, it's fairly common you pay a fee when you've had a covenant violation and you get a waiver. Well, when you've had the covenant violation, actually your debt is due on demand. It's no longer term debt. And if you can get that waiver for free, I assume we say that there is no change in the debt agreement, and you continue with the accounting. But if you pay a fee, then effectively you're paying a fee to convert an on-demand piece of debt to a term piece of debt. And I think that would throw us into extinguishment accounting, just because you've paid a fee to change the timing and amount. So thinking through those covenant defaults and the accounting, I think would be important as part of this process. But that would be a common example. And I can kind of reconcile to that because when you violated a covenant, you do have due on demand debt. So set aside what we're doing on subjective acceleration clauses. Other cases, maybe you've changed the name of the entity and you need to redocument your debt. you've done something else and the bank wants to charge you a fee. I think under our model, that would be an extinguishment. To me, it seems like some of those are more just a documentation type fee. And I know once you start trying to exclude something, you run into some issues. But ideally, I would love to find a way to exclude those so that if the change in the agreements is not consistent with some form of significant, I don't want to say significant because I don't want 10% test, some form of cash flow, maybe there's a way we could identify that population. I'd be more than comfortable going out with all cash flows, any means any, in our exposure draft and asking that question to make sure that we could get some better thinking versus trying to do outreach and come up with it, because I think you'll just hear snippets of information. But that would be kind of my rationale on that one. Okay. Fred.
Wouldn't it be possible to amend A to have core cash flows include fees?
In the same place.
I think you're in this. Then I think you mean.
But and maybe then really this gets down to the definition of what fees should be
Correct. And
be included.
And what's reasonable and customary for those fees, and you get into all those issues, right? Yeah. Nobody likes reason. It's in the eye of the beholder, right? I agree with you. I think that makes them the same.
But see, I mean, the point is that, I mean, and my vote for B was really that how do you, if there's essentially a de minimis fee for processing, do we really have an extinguishment that needs to go through extinguishment accounting? That was just my point.
Yeah, and that was the same thing I was saying.
So maybe there's some way to deal with
So you voted A for that concern. I voted B, but want to explore if there's a way to find it. So it sounds like it's the same thing. Okay, Chris, back to you. Question 4.
Thanks, Rich. Actually, now tee up questions 4, 5, and 6, all of which relate to a potential principal amount measurement election. For context, when extinguishment accounting is applied under current guidance, borrowers initially measure the new or modified debt instrument as fair value, as we've been discussing. The questions in this section ask whether, as a simplification, certain entities should be permitted to initially measure the new or modified debt instrument at its principal amount instead of fair value. So I'll go through these in order. First, we're going to ask which entities should this election apply to, if any. Second, whether the election should be a transaction by transaction election or entity-wide. And third, whether the election should be precluded when there are multiple units of account. So starting with question 4. Question 4 asks which entities, if any, should be eligible to apply the election. The staff thinks the election should be available only to entities other than public business entities, which we've been referring to as non-PBEs. Unlike public business entities, non-PBEs are not currently required to disclose the fair value of their issued debt instruments. As a result, requiring fair value measurement after a modification or exchange would be more likely to create incremental costs for non-PBEs than it would for public business entities. In addition, and we've learned a lot from discussing this with the PCC, private company users have consistently told us that they focus primarily on contractual terms, such as the timing and amounts of principal and interest payments, rather than on the amounts reported under GAAP. While limiting costs for non-PBEs would be an advantage of a principal amount measurement election, the staff also thinks there are drawbacks to that approach. Initially measuring debt at its principal amount could place significant emphasis on whether cash flows are labeled as principal or as interest. That in turn could certainly create structuring opportunities. And then even separate from structuring, we also understand that, and we learned about this through our outreach as well, that modified debt terms in normal course sometimes just do not reflect the market rate of interest. And in those cases, the principal amount would not be a reasonable approximation of fair value. So on the basis of those considerations, the staff recommends permitting non-public business entities to measure the modified or exchange debt at its principal amount. The staff does not recommend permitting public business entities to do the same, because those entities are already required to disclose the fair value of their issued debt instruments, and because investors in public business entities appear to place greater emphasis on certain GAAP-derived metrics, such as leverage and interest coverage ratios. And those could be susceptible to structuring under this election. The next question, question 5, asks whether the election should be on a transaction by transaction basis or as an entity-wide accounting policy election. A transaction by transaction election would provide more flexibility, including for a non-PBE that is preparing to become a public business entity and may want to stop applying the option prospectively. By contrast, an entity-wide policy election could require retrospective recasting of prior periods and an assessment of preferability if the entity later changes that policy. The staff acknowledges that a transaction by transaction election could also create structuring opportunities because entities could choose the election when it produces the preferred accounting outcome. However, given the private company user feedback that I just described, we think that concern is outweighed by the cost savings and flexibility of allowing the election to be made transaction by transaction. And as a result, we recommend that the election be made on a transaction by transaction basis. And then finally, for question 6, that question asks whether the principal amount election should be precluded when the effective interest rate of the debt instrument is different from its stated rate because multiple units of account were identified at issuance or upon a modification or exchange. The purpose of that limitation would be to avoid counterintuitive outcomes. For example, if a borrower separately recognizes a warrant or a derivative in connection with a debt restructuring, measuring the debt at its principal amount could double count the warrant's value or otherwise produce an outcome that does not faithfully reflect the economics of the transaction. The staff acknowledges that this limitation could reduce how many restructurings the election is available for. For example, we understand that non-PBEs commonly issue notes together with warrants, and in those cases, the election would not be available. However, the staff thinks that the need to avoid highly counterintuitive outcomes outweighs the concern that the limitation may reduce the applicability of the election. For that reason, the staff recommends precluding the principal amount measurement election when multiple units of account are identified either at issuance or upon a modification or exchange. And with that, I'll pause and ask the board to discuss questions 4 through 6.
So Chris, just to verify, the guardrails around the election for non-PBs are what? They are
Multiple units of account.
just
And
multiple units of count and
that's it.
nothing on interest rates.
Correct.
And when it comes to related party lending, right, which I think gives rise to a lot of the issues for the private companies, is there a requirement today to reset the interest rate on an initial borrowing to a market rate with an adjustment to equity? Because I don't think there is.
More generally, at initial recognition measurement, it's going to be based on proceeds. And then there's a presumption that I'm not aware is rebutted frequently that your initial measurement of debt is at proceeds. The challenge we have in modifications and exchanges is that there might not be any cash being exchanged.
No, understand. So particularly for the non-PBs, right, where there's more related party transactions, right, the principal owner lending money and so on, that debt is unlikely to be at market. Or it may be, but it may not be. It probably depends on the tax treatment that the lender's looking for, right? And the broad range they have, which might be different. So, okay. Yeah, that's kind of where, are we only talking about third party lending? We're talking about all lending when we're talking about this for the non-PBs, correct?
Yes, for non-PBs, this would be when there is a modification or exchange and it trips extinguishment accounting. So the same scope.
Regardless of the lender.
Correct.
Okay. You know, as we go forward, that might be something to get some PCC feedback on as to how whatever we're doing works with that, because we may find this brings a little different accounting or focus to some of those related party transactions. Okay, that was just a question. All right, so which questions are we doing? 4, 5, and 6? Okay. Oh, Fred, go ahead.
So a quick question for Kathy. Kathy, the academic research you cited, that was done on public companies or on all companies?
It's on public companies, and it's actually not on extinguishment accounting. It's about credit risk, and one subset of them is about the credit risk, own credit risk,
Own
right?
credit risk.
Entities' own credit risk, and then
Right.
to the extent you see things marked to fair value, which usually is financial institutions, that's when you start to see reactions to gains and understanding of the future. But it's not specifically extinguishment accounting. So their conclusions could reasonably extend to the gains on extinguishment accounting.
Could, right. Okay, thanks.
I mean, until you test it, you don't know.
And then on question 5, on a transaction by transaction. So a company would be able to basically say, hey, if I get a gain, I'll take it. And if I don't get a gain or a loss, I can do the other accounting, correct?
Yes, that's what we're referring to when we mentioned the structuring risks.
And so what I don't understand then is the cost savings by doing it on a transaction by transaction basis, because don't we believe that the cost is greater when you do extinguishment accounting than you do the simplified approach? So, I mean, if you did entity-wide, you would just basically be doing the simplified approach for all transactions, which is cheaper than doing fair value.
So what we were trying to
So what was the cost savings, I guess?
The cost savings would be if you're doing it transaction by transaction and you, for example, decide I want to cease applying this election for one reason or another and do that for everything going forward. We were envisioning that you'd be able to do that prospectively. You would not have to go back and recast anything you've previously done. If it's an entity-wide policy election, you would not be able to do that prospectively unless we specifically wrote in that an exception saying you could. And we were saying as a default position, we would expect that to be retrospectively recast. And therefore, we thought that aspect would be less costly than
That
what
aspect.
Yeah.
That narrow aspect. Okay, thanks.
Sue, go ahead.
However, and maybe you need to think about this question. If you're a private company and you suddenly make a decision that you're going to go public, could you cite that under preferability that full-blown public company GAAP is more preferable and have an accounting change?
I mean, if you're going to go, generally anybody who's going to go public has to do that.
Yeah. Well, they have to do it anyway,
Financial
but could they do it in advance?
Yes. Yeah. Any other questions? Transaction by transaction, entity wide. All right, Kathy, you ready for 4, 5, and 6?
Sure, Rich. So PBEs already are at fair value, right? I think Rich is absolutely right. As soon as you move from disclosure up to recognition, there'll be a whole lot more precision. So I think there are probably more costs involved in that, but I would not include PBEs in this. So I agree with you that I would limit it to non-PBEs. It's interesting because I also suspect the main users of the financial statements are likely the people doing the modifications with the entity, right? And I think we shouldn't forget that, right, in how we're thinking about this. So I think that's important to consider. When we go with issues transaction by transaction or entity wide, I think the comments are well taken here. And I think kind of having understanding and doing outreach on that is important. But I am kind of drawn to your argument about transaction by transaction. But then I start to think about what would the disclosures look like, right? And again, going back to it's likely the same firm you're doing the modifications with, but even still, if for the entities that have multiple users using their financial statements, I think we should be careful that the debt, some of it's at principal, some of it could be at fair value at the choice of the entity and how those disclosures look. And then I completely agree that as soon as you move into multiple units of account, you get really weird outcomes. And it'll be interesting to see what happens because I think based on the work you've done, much of the debt in this world gets attached with warrants. So I don't know how broad and pervasive this election may actually end up being because of the multiple units of account. But I agree that we should exclude those from this election.
Okay, before I go to Fred, just a quick question. I presume that the requirement to disclose the fair value of debt when you're carrying it at amortized cost relates to PBEs.
Yes, it does.
Okay, and it's aligned to the definition of PBEs. It's not one of our other 15 definitions.
It's a topic 825 disclosure, and it does.
Perfect. Okay, just wanted to check. I knew you guys had checked that. I just wanted to make sure. Fred.
Thanks. On question 4, I think the simplification is a real improvement for PBDs. I would actually like to explore simplification for all entities because I do think that that it's simplified accounting provides investors useful information. That said, I think Kathy made some interesting points relative to the academic research on this, and I think that the staff made some good points about the challenge with application because, although I do think that if you look on the other side, the lender side, we pretty much are comfortable with amortized costs. So it's kind of interesting on that. So I support your recommendation. In terms of transaction by transaction, I think that I don't see how that could possibly be good for any users. That essentially the company can choose to take a gain when they have a gain and not take a loss when they have a loss in terms of this extinguishment accounting. So, and I don't see the cost savings. If we want to write some kind of retrospective issue into something, I would be open to that, and I think we should explore that with clients. But I think the basis should be that it's an entity by entity decision, so that they have to keep that on a go forward basis. And I think the cost save is very particular. The point you made, and the primary cost save is just straight application of it. That's going to be cheaper than having to even go through it. In fact, I would think it would be better for companies not if they choose this on an entity by entity basis, then they can get away from the fair value calculation completely and have a more simplified, less cost effective, less costly approach. Thanks.
Marcia.
So I'm comfortable with your recommendation on question 4. I'd love to see it this simple for everyone, but I think that's a broader project than what we are undertaking at this time. So I support your recommendation on question 4. With regards to question 5, I think no matter which way the majority votes, we're going to get feedback on is there a downside to either by entity or by transaction. So I could support your recommendation with a question understanding if there is a downside to that users of the financial statements would feel. I wonder, frankly, if in essence it would result in an entity-wide election and that you're taking into consideration what if the circumstances of the entity change in the future, and you're making it easy for them to prospectively deal with that. So I'd like to ask the question about our analysis and make sure we get feedback on if others agree with our analysis on that one. And then and to get that question, that's why I'm supporting your recommendation so that we have the opportunity for people to tell us we didn't think about something in our analysis that we should have considered. And then on question 6, I agree with your recommendation there.
Rich, I also support on the recommendation on 6. So
Okay.
I didn't get that vote.
Thanks, Fred.
Thanks, Rich. Okay, so regarding question 4, I support providing an election for non-public business entities only. I think you've raised some valid points and considerations as to why that should be the case. I think quite importantly, this is a cost-benefit issue, and it is an opportunity to have a practical expedient for non-public business entities. Determining the fair value of the debt can require new, costly, and burdensome valuation work for these entities, which doesn't exist today. And it, quite frankly, we've learned that the potential fair value measurement would not necessarily incrementally benefit users. So certainly support there. Regarding question 5, I think the entity-wide approach could provide greater consistency and comparability, but it may also require an entity to apply the same measurement approach to transactions that in substance may be economically different. A transaction by transaction approach, on the other hand, could allow management to better reflect the economics of, let's say, a unique or complex financing arrangement that may have unusual terms or features, which if the transaction by transaction approach is used, the financial statements potentially could be more relevant to investors because of that assessment that has been made for that specific transaction. So for that reason, I support the transaction level approach, but only with required disclosures about the election of each material modified debt transaction. Because to Fred's point, investors would be concerned that allowing management to make the election for each transaction could create opportunities to select the accounting treatment that has the most favorable reporting outcome. So disclosures, allowing investors to understand why management selected the principal amount or fair value measurement approach, and give the investors, the opportunity to better assess the results in the financial reporting. Question 6, I support the staff recommendation. I think allowing an entity to use the principal amount under those circumstances could potentially obscure the economic value of the individual components of the arrangement.
Okay. Thanks, Joyce. Sue?
Thanks. And I appreciate the work done on this, because I think if you think about the journey that we've been on and the discussions the staff has had with particularly I'm thinking about the AICPA Technical Issues Committee. At one point, they were preferring just modification instead of an all extinguishment model, just all modifications because of this issue. And so I think to the extent that we've been able to come up with a solution and an election that helps them, apply this guidance to, if you run the thread through the model that gets everybody on the same basis, I think it's a win. And so I do support question 4 on providing a simplification to non-PBEs. And I think that their users supported it as well. I am interested, it would be interesting to see about expanding it, but I'm concerned about the relevance of the information to other investors and for public companies. And I think that, I think that given the fact that they already have the information they're already calculating, it doesn't really make sense to extend it. On question 5, I'm kind of torn on this one. I think that in practicality, if you put a transaction by transaction election in, I think people are mostly in the private company space are probably going to elect it on an entity-wide basis. There may be some outside chance, much like Joyce just articulated, that to provide more relevant information, they might elect it just for this one type of transaction. And in that circumstance, I would agree with her that it should be clearly disclosed. However, I do prefer, I think, the entity-wide election. I think that it provides more consistency and comparability. And I think that in practicality, that's probably what's going to happen. So I'll probably be in the minority on that.
Okay. Thanks, Sue. Hillary?
With regards to question 4, I support providing a ability for non-PBEs to be measured at the principal amount. I think you guys have made compelling arguments. To Sue's point, I think this is a really critical part of this project when thinking about it from a non-PBE perspective. So certainly I think that this is one where, do we have feasible solutions? This was a really important part of making sure we did have a feasible solution from a non-PBE perspective. So certainly support that. So I'm in a camp of, simplification for entities other than PBEs. I would not extend it to public companies for the reasons that were identified by the staff. With regards to question 5, kind of the same ilk, I think, of a few board members of, we're going to get information one way or another. I came in on a transaction by transaction basis into this meeting, but the more we've had a good conversation here around the table, I take Sue's point of, it starts to feel like even though we're going to give people transaction by transaction election, I do feel that people are going to apply an entity-wide election from a cost perspective. There may be extenuating circumstances that they may want to apply fair value to this, but certainly I think to your point too, on, you could always do that through preferability if that were something that you were looking at for purposes of going public going forward. So I guess I'm now supportive of an entity-wide election with a question of, is there any reason we should allow a transaction by transaction approach? So maybe just flipping it on its head a little bit from a question standpoint in the exposure draft. And then with regards to question 6, I do agree with the staff analysis that entities should be precluded from applying the exception if they have, right, other elements, right? Certainly, we need to make sure that the economics all match up with the accounting. And I don't think in those circumstances, being able to account for the debt at principal amount is going to work from that standpoint. I completely take your point, Chris, that this means that for many non-PBEs, they may not be able to apply the exception. But I do think if there's complexity in your transaction, there may be more complexity in accounting for that transaction. And I do think in those instances, entities already are having to go through more complex accounting to understand the value of potential embedded derivatives, the value of other elements that are associated with those transactions. And I'm not underselling the cost associated with that, but I do think we have to think about it in its totality, and I don't think it'd be appropriate to be looking at the debt at the principal amount in those circumstances.
I didn't answer question 6. I did.
Yeah.
Yeah, I didn't. So I agree with staff.
I guess I need a better scorecard here. Chris, what are your votes on question 5? Is it 3-3 or is it?
I have it as 3-3.
Okay. It's always fun going last. Just wanted to make sure, keep the anticipation up. So on question 4, I would extend the simplification to non-PBEs only. I think if we really want to do it broader, we should really consider the relevance of fair value for own debt. And that would include the disclosure requirement as well as the fair value option. And I'm more than willing to consider that, but I think that's broader than this project. So I wouldn't simply do it here. I think if we're going to do it, I would do that as part of that broader project and consider eliminating the current disclosure requirements and eliminating the fair value option. So for all those reasons, for this project, I'll focus on C, non-PBEs only. Question 6, I'm going to jump to, because I think they're chair's discretion. I agree with the guardrail you've inserted. My question is, do we need more? And I think part of that is going to be related to the related party arrangements versus not. It seems like there should be something on the interest rate, but we don't have anything there. And so that was the one thing that gave me pause. And maybe I don't care because the instances where you're most likely to get an uneconomic debt arrangement are a related party transaction. And since we don't seem to have a scrutiny of that today, I can kind of live with that. So on question 5, I'm entity by entity, but I still have the question on related parties and the related party lending arrangements. So I think that would be the entity election for the non-PBEs. So on question 5.
Entity-wide?
Entity-wide.
Yeah.
Entity by, yeah, entity.
Entity by entity, it means entity-wide.
Well, all right.
Sorry.
Holy cow. So with that, 4, 5, 6, 7, and 8, back to Grace. Thanks, Grace.
Thank you, Rich. Questions 7 and 8 in the board meeting handout focus on the TDR guidance for borrowers. Question 7 asks whether the board wants to retain or eliminate the TDR guidance, and question 8 asks if the board does decide to retain that guidance, whether the measurement model should be changed to require the initial measurement of the restructured debt at its principal amount. I'll start with question 7. As I summarized earlier, eliminating the TDR guidance was the most common suggestion received from stakeholders that supported standard setting in this area. It was also raised by some stakeholders in response to the 2021 agenda consultation. The staff thinks eliminating the TDR guidance has 2 main advantages. First, it would address concerns that the current TDR accounting model does not always provide decision-useful information. Stakeholders most often raised concerns about situations in which a borrower recognizes a restructuring gain and then recognizes no interest expense after the restructuring, even when the restructured debt is interest-bearing. Eliminating the TDR model would remove that separate accounting outcome and instead subject those transactions to the same modification and extinguishment framework that applies to other debt restructurings. Second, eliminating the TDR guidance would simplify the accounting analysis. Under current guidance, borrowers need to first assess whether a restructuring is a TDR before determining whether subtopic 470-50 applies. That sequencing can add cost and complexity, particularly because determining whether a borrower is experiencing financial difficulty and whether a creditor granted a concession can be challenging. Eliminating the TDR guidance would remove that threshold analysis and result in a single model for borrower debt modifications and exchanges. The staff also considered potential disadvantages. One disadvantage is that entities would no longer identify restructurings as TDRs under GAAP. Some stakeholders may view that designation as a signal that the borrower was experiencing financial difficulty and received a concession. However, more recent investor feedback suggests that the TDR label itself does not provide significant incremental information beyond the terms of the restructuring and the borrower's financial condition. A second disadvantage is that if TDR guidance is eliminated and the board expands extinguishment accounting, some distressed borrowers could initially measure restructured debt at fair value and recognize a significant extinguishment gain at the restructuring date, followed by higher interest expense in later periods. The staff acknowledges that outcome, and some stakeholders have questioned whether fair value measurement is appropriate when restructured terms are not negotiated at market rates. However, the staff observes that fair value is commonly used to initially measure liabilities in GAAP, and that measuring restructured debt at fair value is not fundamentally different from other fair value measurements. Overall, the staff recommends eliminating the TDR guidance and subjecting those transactions to other applicable GAAP, including the guidance in subtopic 470-50. The staff does not think that qualifying as a TDR should exempt a restructuring from extinguishment accounting. If the board decides not to eliminate the TDR guidance, question 8 asks whether the board should instead change the TDR measurement model. Specifically, the question asks whether borrowers should initially measure restructured debt following a TDR at its principal amount. This measurement model would be the same one as discussed in questions 4 through 6. The staff thinks that approach would have two advantages if the TDR model is retained. First, it would address the most frequently cited concern with the current model, namely that no interest expense may be recognized after some TDRs even when the restructured debt is interest-bearing. Measuring the restructured debt at principal amount would allow subsequent interest expense to reflect the stated contractual rate. Second, it would preserve the identification of TDRs for stakeholders that continue to view that designation as useful. However, consistent with the staff's earlier discussion of the principal amount measurement election, this approach also has drawbacks. Initially measuring debt at its principal amount could place too much emphasis on how cash flows are labeled and may not faithfully reflect the economics of off-market terms. In addition, the board that deliberated FAS 15 considered and rejected a principal amount measurement model when it originally developed the TDR guidance. Furthermore, we also note that while warrants are sometimes issued to partially satisfy debt in a TDR, there would not be a limitation on initially measuring debt at its principal amount following a TDR under this alternative. Therefore, the staff's primary recommendation is to eliminate the TDR guidance. If the board instead decides to retain the TDR guidance, the staff recommends revising the guidance in subtopic 470-60 to require restructured debt to be initially measured at its principal amount. I'll pause there and pass it back to the board to discuss questions 7 and 8 in the handout.
Any questions for the staff? Fred?
So just to be clear, and the issue is that if I have a problem borrower and I simply extend the terms, go from a 5-year note to a 15-year note, that would trigger a large gain, correct? Or a significant gain.
Are you saying this when extinguishment accounting is applied or when the principal amount?
Because we basically have gotten to the point where
Yes.
if we get rid of TDRs, we'll apply extinguishment
We'll have
accounting
a
to
huge gain and
TDRs.
then very high interest expense.
Right.
Going forward.
It would be relative to what were the original terms. If for example, if they were already at a very high interest rate and they're still at that same market rate, not necessarily, but in a lot of cases where they were not originally troubled and following upon restructuring, they've become troubled, then yes.
Right. I mean, okay.
TDRs tend to be a decline in ability to pay back.
Yeah, so I'll throw out a hypothetical if people will. So I'm a private equity company. I've got private debt in a fintech company. It's troubled. So basically, and I think it probably needs capital because it's fintech. But I can essentially extend the terms of the debt. I would, in all likelihood, book a gain, and then suddenly I would essentially have a non-dilutive capital raise because the gain would go through retained earnings. Is that correct?
Yes.
Thanks.
Any other questions? Okay, Sue?
So this has been an interesting discussion. I think that, the discussion with IAC was sort of interesting because they, in effect, sort of suggested they don't actually see a lot of TDRs and that the label doesn't really mean a whole lot to them. And so then you sort of think about, well, gosh, there must be more in the private company space than maybe in the public company space because of the focus with which many of our IAC members have. And so for me, the thing here is really just ensuring we have adequate transparency. So meaning the disclosures need to be good, and we need to make sure that there's clarity around when we have a modification, what the terms were before, what they are now, particularly in this space. And so from that perspective, I think that simplicity in the model, having a single model, is really important. And I think that the information that is garnered from that single model and applying an extinguishment model could be very useful. And so from that perspective, I would support the staff's recommendation. I would eliminate TDRs for borrowers. And then I think, well, I don't think 7's relevant for me, right? Or sorry, 8. Right. Although if it comes back around that way, I would support just retaining.
Joyce?
Okay, so I support the staff recommendation, alternative B. I think eliminating the TDR accounting would move the guidance towards a single, more consistent model for debt modifications and exchanges. In addition, I think it would allow greater simplification for preparers, certainly, since it would eliminate the need to apply 2 separate accounting models. It will help in terms of the unnecessary complexity that they're challenged with today. And an important reason here is TDR accounting, I think, can obscure the economics of the debt restructuring. Nevertheless, as Sue has also mentioned, disclosures would be quite important because investors will need to have sufficient information to identify the drivers of the restructuring, right? So what is the reason? What's the financial difficulty that's ongoing with that particular entity? And they need to understand the nature of the new arrangements, whether or not there are any concessions, for example. They can use that in order to better assess liquidity and credit risk for that particular entity. But I think Fred's point is an important one in his question. I think we should learn broadly as we continue with this project whether the greater consistency, the comparability, the simplification, and the transparency from an all extinguishment model outweigh potentially introducing gains and losses for modifications that may not have resulted from substantive changes in the economics of the debt. It's likely that investors, they may adjust the gain or the loss in their analysis, but it will reside in the balance sheet, to Fred's question, within the capital. So I think we do need to continue to understand what the implications of that is to investors. And question 8, I don't need to answer at this time.
All right, we'll come around to question 8 if we get 4 to keep. How's that? Marcia.
So I'm going to support the staff recommendation on question 7 and maybe set up a future board to hear something a little different on its next invitation agenda consultation. I appreciate that we've heard about this for a long time. I also am sensitive to where Fred is going, but we have other areas in GAP where you have counterintuitive outcomes. Again, I'll bring up an old topic that some around the table have heard me mention before, and that would be having to mark fair value on contingent consideration. There's another example where you get counterintuitive outcomes, that what's ultimately maybe bad news for the business gives you good news for your income statement and vice versa. I'd be happy to deal with that too. But I think what's important, and I will support robust disclosures, because I think that's what's really important to identify for the users of the financial statements is, at the end of the day, what is triggering this particular transaction. And I think we can get at that through disclosures and simplify the accounting model. And I welcome feedback from others once we get to an exposure as to whether this really is responding to what we've heard.
Okay, Fred.
I don't think I've ever knowingly voted for a counterintuitive outcome. I hope I haven't.
It's all where you sit, Fred.
So look, I think this gets at the issue where disclosure doesn't work. And that is, we know we have a huge private equity out there, private debt out there. So there's all this private debt. Investors, folks like us, invest in funds that have a lot of private debt in them. They don't look at the individual debt disclosures. So disclosure really doesn't work in that situation. Sure, I think a disclosure option, if you're talking about public companies, maybe that could work. But for this issue, I don't think a disclosure option works. Secondly, I think Sue's comment about the IAC was interesting. I think the average age on the IAC means not very many of them have been around for a credit cycle. And the challenge in a credit cycle, for those like me who are old enough to remember a couple of them, is that what happens during a credit cycle is that lenders and borrowers neither want to recognize the loss. And so there's a long history of what's called extend and pretend by lenders to try to push off the losses as long as possible. And here, in my view, if we get rid of TDR accounting and apply extinguishment accounting, we're essentially allowing what I would consider extend and pretend. And that is this real capital that you're booking with the gain that we talked about? Is it like going out and raising capital from investors and putting real cash into the company? No, it's simply an accounting gain. And so as a result, in my scenario, in my view, you've essentially said, okay, here's an accounting that allows a lender to simply extend the terms of the loan and book capital. Now, in some companies that may not matter, but in any financial and essentially any heavily debted company, the amount of capital in the balance sheet matters. And so in my view, this accounting would be, in my view, essentially worse in some ways, in my view, than being counterintuitive. It would actually could promote kind of a extend and pretend. So obviously, as a result, I don't think extinguishment works for TDRs. That said, I don't think the current TDR accounting works. And so I think that, since I don't think maybe, long shot. But anyway, I do think we have a real path here for better accounting. And that is, yes, we have to retain TDRs. We won't get rid of them. But if we take option 8B, we've greatly improved the accounting for TDRs. We've simplified it. And we've provided better information to investors. So that's the direction I would go. Thanks.
Thanks, Fred. Kathy? Don't dash Fred's hopes.
Yeah, sorry, Fred. I'm going to say eliminate TDR accounting. Sorry to break your heart. So when I think about this, I think, when I look at the research and I read what people like this is, I go, these are real economic transfers, and we have to be really think about that. And I think we also have to be really careful in overly focusing on just the gain. So we're talking about the transaction for the debt, but that is within the context of a broader set of stuff that's going on. And there's if this company's in a troubled debt restructuring, it's probably not looking really good on the asset side either, right? So I'm going to guess there's a lot of stuff going on. So I really struggle. I get the counterintuitiveness of the gain, but I think if you take a step back and think about what's happened, there's been a transfer of wealth from the lender to the borrower, along with really bad stuff happening to the borrower. I think you have to look at the whole package. I also think people worry about the gain, and we've heard from our investors low or no interest expense. I think that's actually worse, right? Because the gain is a 1-year thing, while the low and no interest expense goes on, right, for multiple periods. And it requires investors remembering that 4 years ago, there was a TDR. And that kind of bothers me. We also work really hard, I think, a lot of the time to do substance over form, right? And I also think the lender, to Fred's point, is trying to ensure they get as much cash back as possible. So they will structure that deal in a way to maximize the cash return. And they may call it interest, they may call it principal, they might even call it fees, right? But in the end of the day, they're going to structure a deal that maximizes their cash return. And I'm worried about the principle only because I don't know what that is in this situation. I agree with Sue. Disclosures are really key because you have to be able to understand what is the nature of the change in this contract. And I really like the idea we now have one model that, assuming we can get the disclosures right, that will really simplify everyone's understanding of debt. We don't need to make this complex. And I think pulling TDRs out gives us a really simple, nice, beautiful even model that would have supporting disclosures that will allow people. I think that means I don't have to answer 8. So.
Okay, thanks, Kathy. Hillary.
Appreciate all of these strongly held views on this particular topic. And, to Marcia's point, right, we have heard about this issue over time through agenda consultation. And some of us have lived and breathed this question many, many times over, working through it with clients. Because we have to remember, this is the starting point for the analysis for any debt modification or extinguishment today. So I think when we hear, at least personally, when I hear feedback from investors that the label of a TDR or a troubled debt restructuring isn't necessarily very decision useful, and then you couple it with obviously the model we have today, which I don't think provides any decision useful information. I struggle with the fact that we have a label that's not decision useful, and then that label is expensive. Trying to figure out whether or not an entity is in financial difficulty and whether or not they've been granted a concession. I take the point of others will say, right, it's generally clear when that happens. It can be very clear. Things can be going really far south, right? And then it's a pretty easy analysis. But there are a lot of those instances where you're in a gray area, right? And you're trying to spend time and energy to figure out what could be, if you were trying to refi with another party, what would be the market rate of interest. There can be a lot of time and energy spent on something that I'm concerned doesn't provide decision useful information from an investor's perspective. So I do think that I support removing TDRs from the model today. I certainly do believe, and I already gave my views with regards to extinguishment accounting. I think extinguishment accounting reflects the economics. Something happened, you have a gain or a loss. In this case, it'll probably be a gain, right? If it's a TDR, that is the economic reality of the lender has granted a concession to the borrower. I get the fact that that's going to result in a higher interest rate going forward, and I understand that that may be counterintuitive to some, but I think it provides information that investors can then use for purposes of understanding what happened. And that's where I think disclosure, again, is really key, kind of to our many other board members' views with regards to this. So I personally think TDR, to me, addressing this is really a disclosure issue of understanding why did you make the modification to the debt arrangement. Understanding that, I think, is going to provide more decision useful information to investors than having folks go through a costly and complex analysis to put a label of TDR, which may not be something that they're using today. So certainly I do think that even just having it today adds complexity to the model. I agree with Kathy of, there's a simplicity to saying, if you change the terms of your debt arrangement, here's how you account for it. And the disclosures can be tiered based on, characteristics of why you did that or characteristics of the borrower, right? And I'm certainly open to hearing back from the staff with regards to if we need to think about enhanced disclosures in that way. So certainly I think I'm supportive of the staff recommendation, and I don't believe I need to answer question 8.
I might answer. So when I think about this project and why we're doing it, I started off with when companies borrow money, they have a choice very often of refinancing with their existing lender or refinancing with a new lender. And bizarrely, based on the way our modification versus extinguishment test worked, you could end up with different accounting depending on who the counterparty was. And so when I look at that to me was a refinancing decision. And we made some decisions earlier related to the what will trigger effectively extinguishment accounting, which in my mind is the refinancing accounting. And we'll certainly get some feedback, particularly on the fee issue there, on whether we've pulled too much in. But when I look at that, and then I think about a borrower who can't refinance their debt with anyone, and that's what I think of as a TDR. And it's basically no one is willing to lend them money on any terms, and the lender is basically just trying to get back as much as they can. And very often their decision, at least in my experience with TDRs, is put them into bankruptcy or work out the debt so that you can possibly get your money back. And Fred highlighted some other considerations. And when I think about that, and then I look at the criteria that we have today of indicators of a lender or a debtor experiencing financial difficulty, it includes currently in default on any of its debt, has declared or in the process of declaring bankruptcy, absent the current modification, cannot obtain funds from other sources, based on estimates and projections that look at the current business capabilities, they can't repay the debt. And I say, okay, so in that instance, you should book a gain. And I struggle with that. And I think there's some improvements we could make to TDR. First off, get rid of the word troubled, because I will tell you, you sit down with the entrepreneur and you tell them they're having a troubled debt restructuring, and then you're going to tell them they're having a going concern. It certainly raises the pressure, which I think puts a lot of pressure on practitioners, because the way you talk about that discussion, I think, so I'd probably call it debt restructurings. I'd also look at the application, like when we apply it, and also the definition of the concession. And I think by looking at those and effectively looking for reductions in principal amounts and so on, we could probably come up with a narrower application of current TDR accounting. But I do struggle with this big gain when the worst news is hitting, to Marcia's point. When you have contingent consideration, things are going badly, you have the gain. I don't get that one either, Marcia, so I'm with you on that. But in this instance, I really struggle that the record earnings of a company are going to be on a restructuring of debt that they can't repay right before they declare bankruptcy. So I would preserve it. I think we could improve it. I think this is pretty fundamental to the project too, because I think it really defines what are we trying to do. So for those reasons, I would agree with Fred, but I think there's 5 other votes going the other direction. So we'll head the other direction. So with that, let me go on to enhanced disclosures and go back to Gus. Gus.
Thank you, Rich. The next 3 questions in the handout relate to disclosures. Questions 9 and 10 address disclosures for modifications and exchanges within the scope of subtopic 47050, and question 11 addresses debt disclosures relating to SEC Regulation SX. Question 9 asks whether the board wants to require additional disclosures for debt modifications and exchanges. Currently, subtopic 47050 contains limited disclosure requirements, while the TDR guidance in subtopic 47060 includes more extensive disclosures. The staff considered whether certain disclosures that currently apply to TDRs should apply more broadly to debt modifications and exchanges. Specifically, question 9 asks whether entities should disclose A, a description of the principal changes in terms, C, the gain or loss recognized upon the modification or exchange, and D, the related per share effects. Those three disclosures are based on the existing TDR disclosure requirements in subtopic 47060. Question 9 also asks whether entities should disclose the reasons for entering into the modification or exchange, which is disclosure B under question 9. That disclosure is not based on existing TDR guidance, but the staff thinks it could provide useful information about the circumstances giving rise to a restructuring, including whether a borrower's financial difficulty may have been a contributing factor. The staff recommends requiring each of these disclosures for all modifications and exchanges within the scope of subtopic 47050. However, we recognize that the disclosure relating to the per share effects of the modification or exchange is a holdover from when gains recognized in a TDR were treated as extraordinary. We also note that while this disclosure was originally an after-tax disclosure, it was amended in Statement 145 to become a pre-tax disclosure. Therefore, we ask for feedback on each of these disclosures individually rather than as a single package. Question 10 asks whether the disclosures should be required for all modifications and exchanges or only modifications and exchanges that result in extinguishment accounting. The staff recommends requiring these disclosures for all modifications and exchanges. The staff thinks the principal changes in terms and the reasons for entering into the transaction may be relevant, even when the transaction does not result in extinguishment accounting. This includes when changes relate to covenants, collateral, maturity, or other terms that users may view as important. Finally, question 11 asks whether the board wants to enhance the general debt disclosure requirements for all entities. We observe that there are certain debt disclosures that are currently required by SEC Regulation SX for public companies, but are not required for non-PBEs or other entities not subject to requirements in Regulation SX. Some of the disclosures in Regulation SX will become applicable to all entities under the amendments in Update 2023-06. However, their effectiveness depends on future SEC action. For that reason, the staff is asking the board to consider the relevant Regulation SX debt disclosures discussed in this handout, including those addressed by Update 2023-06. The staff recommends requiring all entities to provide those Regulation SX disclosures. The staff thinks those disclosures would provide users with additional information about an entity's debt arrangements and would better align debt disclosure requirements across entity types. This, however, would exclude disclosures related to events of default because the board plans to address those in its project on subjective acceleration clauses and debt default disclosures. To summarize, the staff recommends that the board require the proposed modification and exchange disclosures, require those disclosures for all modifications and exchanges within the scope of subtopic 47050, and require all entities to provide the Regulation SX debt disclosures discussed in the handout, excluding events of debt of default disclosures. With that, I'll pause and ask the board to discuss questions 9, 10, and 11.
Okay, thank you. And so some of the SX disclosures, right, that we passed contingent upon the SEC doing their rulemaking on Duster. Understand this is a chance for us to say, hey, we'd require them for private companies anyway, and just in case the SEC doesn't finish their rulemaking. But some of those will overlap somewhat with the description of the principal changes in terms, right? Because you have to describe the principal terms of debt under the SX disclosure requirements, right? There's something, the amount and timing, let's see. The amount in terms, is it only of unused? I guess what I'm trying to understand is if there's any overlap between anything that we decide to do related to changes in debt with the SX requirements, we'll make sure they work together, right? Because it's possible there is some. And simply by describing the terms of your debt, if you do it for both years, you've effectively described the change. You may not have described the reason for the change, but you certainly have the different debt terms there. Okay. Is that fair?
Yeah, I think we acknowledge that there's definitely a little bit of overlap on some of those, but like looking at Rule 502, 22A, which gives
Right.
is the general character of each debt type, the date of maturity, the interest rates. We thought of the description of the change in terms is slightly different because one is describing a point in time, the other is describing what changed between. So I don't know that we saw those as being identical, even though, to your point, you might be able to discern what the change is if you knew the before state and the after state. So I think we didn't see those as identical, though.
Okay. All right. No, that's fair.
Can I ask?
Go ahead.
So let's say that you had a change in collateral, because that's how I was kind of thinking about it, right? You wouldn't necessarily, under the character of the long-term debt, have clarified what was the collateral underneath it. But if you had a change in your debt arrangement to change the underlying nature of the collateral, that would be something that would be picked up by our disclosure. Is that fair?
Yeah, that's what we're attempting to say, is to describe what changed from point A to point B, whereas we think a lot of the SX disclosures will just have you say, as of this date, what is point B?
Okay.
Could I ask a question?
Yeah, go ahead. So,
So on question 9A, the intent by a description of principal changes in terms was sufficient granularity. Like you intended that to be sufficiently granular. So you would disclose the terms before, you would disclose the terms after, or is that not what you were intending?
No, I think that's consistent with what we're intending. So just as background too, that disclosure, which is from 470-60-51A, it's essentially a shortened version of the current TDR disclosure. So that's an item, though, especially if TDR model is completely eliminated. I think it's something we'll also continue looking at as how do we make sure we are picking up everything that's getting provided under the current TDR model. So that is something we have our eye on as a next step as well.
and because we no longer have a TDR category under our proposal, we may have to over disclose on other modifications to make up for that shortfall. So everybody has to do it. Got it. Okay. Any other questions?
Ready to go?
Yeah. Sue?
So I think the disclosures are incredibly important here, and I would support the staff's recommendations in question 9, and appreciate that you're going to continue to press on those in your incremental research. On question, and I agree with the staff's recommendation on question 10. On question 11, to me, I think that it's important to acknowledge that the anticipated impact of including some of these disclosures from SX is really as it relates to non-PBEs. But I do think that it's much better for the codification to be complete. And so I would support the staff's recommendation on that one as well.
Sorry, can I just one more question on 9D? If we were to vote for that, anytime you had a gain or loss on an exchange, you'd have to disclose an EPS on a pre-tax basis.
Yes, this is now, it turned into a pre-tax disclosure when the board did statement 145. It had previously been a post-tax because it was linked to the extraordinary items.
And just to clarify, that is the only pre-tax EPS disclosure we can find in the COD?
We're not aware of any that are similar to this that we're aware of.
Okay. And required for private companies
Yes.
Who don't do EPS?
who don't do EPS, but they'd have to do it here. Okay.
And recognizing that's why we worded 9 is not saying, does the board want to take or leave the whole package? It's which of these A, B, C, D.
Perfect. Got it. Okay. Thanks. So,
Well, I wouldn't require it if you don't have to do EPS.
okay. But you would require the pre-tax for a company who does EPS.
I would be consistent with what
Got
we
it.
did.
Okay, Joyce.
Thanks, Rich. Regarding question 9, so I would require disclosures A and B, and first of all, I think these disclosures will provide investors with important information for them to assess future liquidity and cash flows. I would expect that in A and B, that it would include information such as, the concessions that might have been obtained, the principal or interest rate reductions, changes in maturity, whether or not there are any extensions. That type of detail I would expect coming out of A and B. I would also require disclosure C because certainly investors need to understand the magnitude of the accounting effect of a debt modification as they assess earnings. They would want to identify what portion of earnings relates to true company operations versus, in this case, a non-recurring debt financing transaction, which investors will likely analytically adjust from their assessments of sustainable earnings. Regarding the per share amount, I think if the gain or loss is separately disclosed, as indicated in question 9C, an additional per share figure might only provide limited benefits to investors. I think it might just be limited incremental information, and therefore I don't think it should be a requirement. However, I think if we haven't directly asked investors about the per share amounts, we should learn their needs.
Okay, thanks, Joyce. Marcia.
No,
I'm sorry.
I think I have a few more to go.
Oh, sorry. Seems like a lot of disclosures.
Yeah. So, question 10, I support your recommendation. Question 11, I also support your recommendation. I think the SEC required debt disclosures should provide users with a much clearer understanding of the credit risk, the liquidity risk, and the debt servicing capabilities. It should also enable better peer-to-peer comparability because investors with access to non-public business entity financial information can evaluate that against peer companies that might be smaller public entities, which they would not be able to do today without that more detailed SEC information. So I think it'll provide investors with a more consistent set of information about debt obligations and financial risk.
Okay.
Rich, can I ask a real quick question?
Yeah, go ahead.
The election for non-PBEs, is the staff's view that that would be a separate disclosure, or would that be under significant policies or something?
So we were planning to bring that back. We heard felt like we were hearing things around the board table that there was interest in making sure it's clear when somebody is applying that election. And again, because it's entity wide too, I think we'll evaluate what would already be provided now that we know that versus what do we need to add incrementally to make sure it's clear.
Okay, so this isn't necessarily our first cut.
Or last. Marcia.
Okay, on the disclosures, and I said earlier that I agree that we need robust disclosures. To me, that is linked with removing the TDR classification. So I support A, B, and C. I question the utility of any pre-tax EPS disclosure. I don't know what that's relative to. So if there was a requirement to have a per share amount for public entities that disclose EPS, to me, that is only meaningful on an after-tax basis. So I'm not in agreement with a pre-tax EPS. I am comfortable with this being for all modifications. Again, that to me is linked to the robust comment I made earlier and also linked to removing the TDR classification. I see that. I'm comfortable with the codification referencing regulation, the SX disclosures for all entities. I'm comfortable with that. And before my microphone goes non-green, I would just indicate that I would support that broad project to take a look at fair value of debt and its utility, but I agree it's not in the scope of what we're trying to address here. It's not as targeted.
So before I talk about disclosures, I would caution my fellow board members about the importance of disclosures being able to offset counterintuitive outcomes. I think, as I mentioned earlier, a tremendous amount of investment today is one step removed from the lender. In other words, there's a tremendous amount of private debt that is owned in funds. It's owned through BDCs. It's owned through a lot of different entities. And the disclosure that the ultimate investor gets in that isn't necessarily what we're providing here. Usually it's a truncated version of what's provided. So, the ability of disclosures, again, in my opinion, to offset an inflated capital account is very limited. So that said, I do love disclosures. On 9, I think I also support, I think as my other board members said, A, B, and C. I think that can be helpful for the people who do look at the disclosures. In terms of per share, in my view, that's the purview of financial analysis, not the purview of accounting. As an analyst, you do all kinds of per share stuff. And as an investor relations executive, you have to correct them and say, did you take taxes into account? But that's, in my view, that's clearly in the role of financial analysis. And I don't think it's necessary in the codification. And I would support the staff on 10 and 11. Thanks.
Kathy.
I agree with Fred. The utility of D is highly questionable, so I would not have D on my list. A, B, and C, I think everyone has said the importance of disclosures is really important. So I would be supportive of making sure that we know that A, B, and C is actually sufficient information, and then understanding that in case we're missing anything. And to Joyce's point, the reasons, do we have to be something more specific than reasons? I would go with all modifications too. I think it actually helps with some of the concerns that you raised in the memo around structuring, right? If you have to actually describe what you did and why, it's kind of helpful. And then I agree that we should make Reg SX applicable to non-PBEs. Thanks.
Hillary.
With regards to disclosures, I agree with the staff recommendations that are included in paragraphs 9A, B, and C. I do not agree with further expanding the per share amount of the gain or loss on a pre-tax basis. I object on 2 different levels. 1, pre-tax, and 2, specific EPS guidance related to the gain or loss. So I don't think that's something that should be included. Certainly, I think that we should have these disclosures required for all modifications and exchanges. Obviously, some aren't going to be applicable, right, if you don't have a gain or a loss on the modification. But I do think the key there being, for me, really being able to provide transparency related to the reasons why you modified the debt and what the changes were before and after. And with regards to question 11, I think this is a great opportunity, right, for us to kind of take a look at the disclosures that are in SX, right, require those for entities that already don't do them today. But I think to the point of the earlier conversation we have, really, having the staff take a look at where do the words overlap, where do we have a disconnect, making sure we don't have duplicative items, right, to make sure that we really have clarity so that we make it as operable as possible and easy for people to understand what the requirements are from a disclosure standpoint.
Okay. So there's a saying that good disclosure doesn't make up for bad accounting, but I recognize both good disclosure and bad accounting depend on your perspective. When it does come to the accounting we're talking about, though, I do think both under 9A, B, and C are relevant. So to the extent they're material, I think those are good disclosures. When it comes to 10, I kind of struggled a bit because one, you won't do the disclosure unless it's material. And if you're making other changes and it doesn't give rise to a gain or loss, like any gain or loss, you kind of wonder, are they ever going to fall into that materiality? So I would have probably been on 10B. And the reason is I think the other disclosures we have would address the other forms of key terms, if there are key terms. And if not, I think we should look at general debt disclosures and deal with it there. And on 11, I am supportive of once again, incorporating the SX disclosures for non-PBEs. I think we'll just have to watch this to the extent the SEC does get the rulemaking done. Automatically, those will go into play. If not, we'll have them here. And I think that'll, either way, it's probably as we get to finalizing this project and looking at exposure draft, it'll be good to look at the package of disclosures around debt and make sure that we're comfortable with where they are. Because I will tell you, I think every advisory group we talk to, when they see what's really required in GAAP for private companies, they're shocked at the lack of debt disclosures related to private companies. Now, some of that's under an argument that, well, hey, lenders know everything. But I'll tell you, I read some news articles about large private companies where it looks like the lenders didn't understand the other financings that were going on. So I do think it's an important financing disclosure. So with that, let me turn it back to Chris for item 12.
Thanks, Rich. The final question asks whether the board has any feedback on the next steps for the Accounting for Debt Exchanges project. As I discussed earlier, the project was intended to address certain multi-creditor debt exchanges for which applying the 10% cash flow test on a creditor by creditor basis may not faithfully represent the economics of the transaction and requires entities to perform that quantitative analysis of a change in cash flows in a manner that stakeholders said was challenging and costly. Because the board decided tentatively today to eliminate the 10% cash flow test and require extinguishment accounting for modifications and exchanges that affect contractual cash flows, those decisions may address many of the issues raised in the separate debt exchanges project. So with that, we wanted to pause and give the board an opportunity to discuss next steps on that other project.
So Chris, obviously, as we went through, you heard a lot of things from the board and we talked about how they're coming back to us. I think we have a PCC meeting in September, which gives us an opportunity to at least talk about the related party transactions and some of those items that came up. But was there anything that any board members felt they needed before the next meeting that you haven't already stated?
Well, I think I've stated, but I think two things, Rich, I would say. One is I do think explaining, especially to investors, what this applying extinguishment accounting to formerly troubled debt exchanges means and how it plays itself out is going to be very important feedback for the board.
Okay. Thanks, Fred. Okay. Anything else? All right. With that, I want to thank the team. Great start. Hillary, did you have something?
I think the question was if we had any feedback with regards to the debt exchanges project. Do you want us to provide any feedback with regards to that?
Oh, yeah. So we have our final but not issued debt exchanges project, which appears like if we go forward with this project, we've kind of gotten rid of the need for. Is there? So we paused that project. Is the board comfortable with keeping that on pause until we move further with this project? And as part of finalizing possibly an exposure draft on that, we'll bring that back to have the board make a decision on whether to simply fully subsume it or not. Does that work? Okay. All right. With that, before we leave, sorry. I think Nellie has a quick announcement on our codifications improvement project. Nellie?
I do. I would like to provide a brief update on our codification improvements projects. On March 25th, 2026, the board discussed our various codification improvements, the issues that would be included in a forthcoming proposed update. One of those issues, specifically issue 5, related to guidance that had been mistakenly removed when kind of processing the codification, and that error has since been corrected, which negates the need for that issue 5. So accordingly, issue 5 no longer needs to be included in the proposed update. We're going to remove it from that proposed update, and Rich is going to ask the board to approve the issuance of the proposed update with that change.
Okay. So we'd already balloted the prior version with 5 in there. So what we'll do is we'll reballot it with it out. I just want to make sure the board's in agreement with that. So if you give me a quick show of hands, all in agreement, 7-0, perfect. So you'll get a reballot very, very shortly. Okay, with that, that concludes today's meeting. Thanks, everyone.